The Korean War from 1950 to 1953 saw an initial sharp sell-off when North Korea invaded the South in a surprise attack. But prices recovered within 2 months or so and actually went straight into a real bull market, driven at least partially by the increases in defense spending. On this chart here, you basically don't even see the dip, only the rising stock prices. So, in the case of the Korean War, an investor who would have bought the initial dip when the bullets started flying, so to speak, would have seen his or her risk appetite paying off quite quickly. Vietnam was a completely different story. The war had been going on since at least 1946 between North Vietnam and French forces in the South, and U.S. involvement grew gradually as we took over from France. Now, on this chart, we have put the yellow box from 1965, when the U.S. began its major troop buildup, to 1975, when Saigon fell. But you could cut it differently as well. From a market perspective, it was all a long, messy quagmire, without a clear beginning or end. There was no dip at the beginning, but later a lot of instability and smaller bear markets, like this inflationary bear market here around 1970. As it became increasingly accepted that the U.S. wouldn't win the war, the stock market began to fall in December of 1972. And then worse came to worse. Inflation, Watergate, the oil price shock of 1973, and the market didn't recover to its previous peak until June 1983, 10 years after the U.S. had withdrawn its combat troops and 8 years after the fall of Saigon. Overall, there were very few winners during this period. In fact, it was so bad that the bear market from 1972 to 1983 ranks as the third most painful market episode in U.S. history.